How can you call the end of sovereignty on a day like today when we're talking about Italy, when we're talking about a no-confidence vote in Spain, when we're talking about Irish stationed officers looking for ammunition again, basically, in case down the line there's problems at an Irish border and Brexit isn't going anywhere? How do you see the end of sovereignty in that environment?
Well, yeah, our point of view is that the end of sovereignty for investors is because sovereigns are actually weaker in their control of economies that are increasingly being buffeted by global forces. And what you're seeing is really a reaction, not necessarily a last gasp, but a reaction to that global trend and their attempt to try and wrest back control within a more nativist and nationalist world. And I think we did say that there would be a lot of volatility as that battle between globalization and nationalism plays out. Within the emerging market context, I would say what you're seeing is something else which is very important, that emerging markets are not a monolith, that there is, in fact, greater EM divergence, and it's increasingly important to see what's happening in Southeast Asia and China with their own very local, very different flows from what's happening in Mexico and Latin America. I will also point out that when Trump got elected, you did see an effect on the Mexican currency, and then there was a bit of a bounce back. And we still think there's just so much integration between Mexico, Canada, and the US. A car manufactured in North America travels 8 times across those borders before it actually gets fully manufactured. Those deep supply chains will win, but certainly there will be lots of noise, and we see this as noise in that long-term perspective.
So, Taimur, I mean, are institutions in the Western world, in, liberal democracies, if you like, are they still better at handling things like financial crises than emerging economies like China, for example, which is managing it from within, from the state level? We saw Italy fall off a cliff 2 days ago, and suddenly we're fine again. Italy's 2-year yield is at 1.27%, admittedly 50 basis points higher than it had been, but we're not talking about that 200, 300 basis point move that we saw Monday, Tuesday. Is that the ECB? Is that European institutions?
I think Italy is a very interesting example where emerging markets were forced to make reforms during the crises in the 90s and the late 80s. Italy's never had that reform for 2 decades. You've had, since the financial crisis, a period where they've grown 15% less well than Germany in terms of per capita incomes, and at the same time, sentiment against Europe has gone up 10%. So you're seeing these lack of reforms leading to the kind of nationalist, Eurosceptical movements in developed countries, in Western markets. And I think that geopolitical risk that is arising there, that politicians are generating in markets, is actually converging them to emerging markets. I think you'll still get EM risk, there'll still be geopolitical risk there, but you are seeing a convergence. You can no longer ignore geopolitical risk in developed markets, and I think Italy is the best example.